This lesson is part of the price action series dealing specifically with short squeezes. So this is going to talk about short squeezes purely from the perspective of price action, meaning I will show you how to identify short squeezes on a chart using candlesticks and explain the trader psychology behind them. Future lessons will also apply analysis to short squeezes, such as CVD, funding, open interest, momentum indicators. But first, you need to understand what a short squeeze is through the lens of price action. You have to remember that price is everything. So before you start to look at other indicators that try and predict a squeeze, you need to understand what a squeeze actually looks like when it's occurring and why it occurs. So now that we have that framing, let's get into it. So what is a short squeeze? Very simply, it is where traders who have shorted a coin are forced to buy it back at a higher price than they sold for. That's a short squeeze. Why does a short squeeze occur? It occurs because there's a sudden increase in demand for the coin, which causes the price to rise sharply. This demand can be genuine in bullish buying pressure or forced through triggering of stop losses and execution of liquidation. Most moves in the market are relatively random and they don't have strong opinions behind them. They're like jet skis in the ocean. But a short squeeze is like the Titanic, in that by the time everyone knows the iceberg is coming, it's too late to stop it. What this means for you is that when everyone is pushing in the same direction, changing direction of the trend is extremely difficult. All day, price just, oscillates and fluctuates up and down with very little real incentive, very little real momentum. But every now and then, there is a particularly strong move that trends hard and runs with very little pullback. If you look on your charts, you'll see these don't occur very frequently. Most of the time, it's just a bunch of jet skis zipping around. But every now and then, there's an unstoppable force that is so hard to turn, so hard to change, that you can just attach yourself to it, you can hook onto the back, ride it up, and take some profit. Why does this occur? You have to remember the path of least resistance that we've talked about in previous lessons. A jet ski in the ocean can turn 180, so it can go in the opposite direction, with little to no resistance. It's very nimble, it can move easily. But a large ship cannot change course without a great deal of effort. And if you even relate this just to humans, because it's human psychology after all, humans are resistant to change. When we start to do something, we like to do more of that thing. And the market is much the same. When it starts to move in a particular direction, it likes to continue in that direction until something forces it otherwise. So you want to avoid the jet skis and attach yourself, hook on to the back of the Titanic. So why trade them? Why trade a short squeeze? Well, when you understand that the short squeeze is unstoppable and you're able to catch it before the end, you have as close to a free money trade as is possible. You have the highest probability of success of any, if you can correctly identify them. So that's why you should trade them. But why do they work? They work very simply because nobody wants to sell in a short squeeze. Meaning, you've got your two players in the market. You've got bulls and bears, right? Normally, bulls are buying, bears are selling. And normally, that creates waves and mean reversion and cycles up and down because the market can't figure out, does it want to go up or does it want to go down? A short squeeze occurs when nobody wants to sell because bulls are buying because price goes up. Bulls are going to buy because bulls always buy. But bears are also buying because they're being forced to. They have to close their trades at a loss. And liquidation engines add support to the move. There's a misconception around order types with short squeezes and liquidations. A lot of people think that liquidations, I'm sure you've all been liquidated at some point. It's a rite of passage for any trader. When your position gets forcibly closed, the common misconception is that this closes just through a market order. As soon as it hits your liquidation level, there's a big market order and it causes a spike and you get taken out of the trade, usually with terrible execution and really bad slippage. That occurs in some instances, but most exchanges, especially Binance, Bybit, the biggest ones, they have two prices. They have a liquidation price and a bankruptcy price. And the liquidation price and bankruptcy price act like a stop limit order, not a market order. Meaning that when price reaches your liquidation price, it doesn't execute immediately. It places a limit order at your bankruptcy price. So the liquidation price and the bankruptcy price act like the limit order. So when price hits your liquidation level, the order gets tagged and it closes it out forcibly. This is done by the exchanges so that they can avoid slippage. Because if, let's say, there was a bunch of people getting liquidated above a high in a short squeeze, if it just all executed as market orders, then the price would spike ever higher and cause a huge upwick on the chart and a lot of slippage for traders. By using more steady, progressive limit orders to liquidate people, it allows price to gradually rise up until everyone gets squeezed out and then fall a little bit more orderly, in a more orderly fashion. That's the theory behind it. It doesn't always work out that way, but when I go to the next slide, you'll understand what I mean by that. And so once a short squeeze ends, what happens then? We get the reverse. there's a sudden decrease in demand for the coin because bulls want to take profit, bears have been fully liquidated, and the liquidation engines have no more work to do. And this equals mean reversion. Okay, so if you ever wonder why we do the common stairs up, elevator down pattern like this, where you go up and up and up, and then all of a sudden down in one go, this is exactly why it happened. The reason you have stairs up is because shorts are getting forced to close, so you have bulls buying and you have shorts getting forced to close. You then have a liquidation engine which is constantly placing limit orders right under the current price because it's trying to exit the liquidated traders with minimal slippage. It's trying to exit their positions without really wrecking them. It is actually trying to do a good job. So that creates a floor under price, which doesn't allow it to pull back. It then continues to rise, and the same happens. Continues, all the way until there's usually a final, like a climax to the move, which is the final sort of blow off top, if you will, and then it eventually ends. Why does it go all the way back down? Now, they don't always look like this, but why does it go all the way back down in one go? Because of those three things I mentioned. We had bulls buying on the way up. Okay, well now the bulls need to sell, right? So we had bulls buying on the way up, but now the bulls, they have to take profit. So they start selling instead of buying. We had bears getting squeezed, but they only got squeezed to this point. After this big candle, they were all squeezed out. So there's no more bears to buy. So we've no bulls buying, we've no bears buying. What does that equal? A lack of demand. And the final thing, the liquidation engine that was rising bids up, it was helping limit orders all the way. Well, that's done its job. The traders have been liquidated. So there's no reason for those bids to step in. And that results in zero demand. And so we go back down until we find a place where there is demand again. And often that is the previous support before the move happened. Because this is where people, if you look, there was no squeezes here. Price was just going up and down. So this is an area where people genuinely were buying and selling. This is where they may have been accumulating. And so logic would dictate when we come back to there will be some actual real demand. But all of this was essentially forced buying and a little bit of bulls buying. And then a lack of interest, everyone has sold, price goes back down. So because you understand the up and down, you now know that squeezes offer some of the best trades because they give you the ability to trade with tight risk and capture outsized moves. If you understand from this lesson that there is forced buying as well as real buying and support from the liquidation engines, the exchanges are actually giving you support on your trade. You can enter with tighter stops because you know that if this is a true squeeze, there shouldn't be a dip down to here. Price should get supported. So you can run with a tighter stop loss, meaning you manage your risk better, and you know that the move can continue until there's some type of finality, and you can catch a bigger move. Also, if you become good at spotting the end of a short squeeze, you can catch the mean reversion trade. So a short squeeze offers two trades. Even if you miss the entire squeeze, you know what's likely to happen after the squeeze, which is the mean reversion back. So you could just be a trader who only trades the way down, you could trade the way up, you could trade both. But understand that instead of trading all this shit, which has no signal and a lot of noise, you can trade the actual volatile moves when they come. Now, what's important to note at this point is these do not happen very frequently. The nature of them is such that they take time to build up. You need many days and days of boring, choppy price action before you can execute a squeeze. So when they come, don't fade them. Meaning, when they come, trade them exactly like this. Sometimes they will work, sometimes they won't. That's the nature of any system. Nothing's 100%. But a short squeeze characteristic just from price action looks like this pretty much every time. So you can use the same template, trade it the same way, manage your risk, and over time, you should be getting outsized winners and hopefully more winners than losers, which means you can make profit and compound your trading portfolio. So I'm going to preempt some questions that people might have. One of them would be, if I use price action, won't I always be late to the squeeze? Meaning, if I wait for it to occur, maybe let's say it's here before you accept and agree that we're in a squeeze, won't I always be late? Wouldn't I have missed all this? Wouldn't it be better to use some indicators or some data or some whatever analysis to find it down here? And I would say the answer to that is yes and no. Using correct trend trading analysis, you can spot the bullish breakout and ride the rest of the squeeze. Meaning, this was the key high that broke. Above the blue line is where the squeeze started. Using correct analysis with price action and volume, you can spot it here and get long. That is very valid and very possible to do. If you think you need to find it here, I will just tell you that you're probably not trading correctly. You're probably not compounding. You're probably not sizing your portfolio, sizing your trades correctly. You should not need to capture this move because it offers way more negative expected value, way lower probability of success. Because if you think getting long here is going to get you the move all the way to here, most of the time you'd be wrong because it hadn't broken out yet. If you wait till the breakout, you manage your risk correctly, you can capture most or all of this move. Confirmation is key. Do not long below the line because it's not a short squeeze until it's above the line. Next question I can predict would be, won't the indicators help me get long before the squeeze? So there are common indicators that denote squeezes, and there are other analysis methods which will be covered. All this will be covered in a later lesson. And I would say, yes, they will help you to understand that a squeeze is likely. But like I mentioned a second ago, they should not be used to predict or preemptively enter a long. Even if you have all your indicators telling you that we're going to squeeze, you still shouldn't enter until here. Why? Because the indicators can be wrong too. No indicator is 100%. And remember what I always say, price is everything. I don't care if funding is the most negative it's ever been. I don't care if there's God himself telling you that everybody's short and we're going to squeeze. Until it breaks above this line and confirms, it's not a short squeeze. But where the indicators and the analysis and the data can help you is when we break there, you can enter with much more confidence. If you have correct risk management, you can size this as one of your bigger trades and you can trade with tighter risk. Because not only do you then have the price action on your side, but you might have funding or CVD or open interest. You might have all of those factors on your side as well. That's more confluence that allows you to size up or take a more aggressive trade. That is valid. But again, even with the indicators, you still don't get long until the squeeze begins. So, in summary, squeezes, they're like the Titanic. You want to jump on them when it's too late, when they're already headed for the iceberg. You want to avoid the shitty little jet skis that are most of the price action in the market, like this stuff. And the best approach is always to wait for the squeeze to begin and then ride the momentum when it's unstoppable. In later lessons, you'll be able to see all the ways that you can help to bolster this strategy. But this has been a lesson on short squeezes. Now let's move on to the next one.